stock market concentration right now is near a record high, and if history is any guide, this may not be a good sign moving forward. As you can see, the last time the market cap concentration in the S&P 500 was this high was right before the Great Depression. But it's not just market cap. We're also going to take a look at how the performance of the S&P 500 has also been driven by just a few stocks. So first, let's take a look at this, which is the market cap of the largest stock in the S&P 500 compared to the 75th percentile stock. That is the blue line on this chart, and there's also a gray line on this chart, which is the weight of the top 10 stocks. You can see they're very highly correlated and pretty much move in lockstep together. Obviously, at the end of the chart here, where we are at now is near this all-time record, and the last time it was anywhere near this was right before the Great Depression. On a small scale, this is somewhat normal market dynamics. Somebody will buy an investment because they think it's going to go up and make them money. And if it does, they'll continue to buy more and the word will spread and more people will buy more of it, which drives the price up higher, which reinforces the fact that investors should buy more of it in order to make money. But that can only go so far. It works until it doesn't. And then once it stops going up, well, now there's no longer any reason to buy it anymore. In fact, the people who bought it because it was going to go up no longer have any reason to even own it, so they turn into sellers. So market concentration, like you see on this chart, is somewhat normal, at least on a small scale, because money will pile into the investments that work the best, that will concentrate investors' capital in a few investments. And then once there is no more money left to buy, it unravels and the whole thing falls apart, which is why you see this tend to peak right before market crashes. In recent history, we can also see the peak in this chart that happened right before the dot-com bubble burst, the Great Financial Crisis, and 2020. So at least in the short term, market concentration at the levels we're seeing right now is not a good sign for markets. Now, unless you are currently retired and are overly invested in this handful of stocks and have zero risk management or hedging capabilities, then you probably don't need to worry about this. In fact, this may actually be an opportunity for you. As the saying goes, you can make money in bull markets, but make fortunes in bear markets. When asset prices go on sale and you are able to buy them for less than they are worth, you create a margin of safety for yourself. And that's really where the magic of compound interest and long-term wealth building come from. But one thing that is also important to note is that not only is the market cap in these stocks very concentrated, but recent performance has been concentrated in these stocks as well. In fact, if you look at just 10 stocks, they account for almost 60% of all of the gains the S&P 500 has had since the October 2022 bottom. But let me say that again while we're looking at this chart of the S&P 500. Ever since it bottomed here in October of 2022, this massive rally that we've had, where the stock market is up currently around 65%, the majority of that performance was driven by just 10 stocks in the entire S&P 500, which is 500 stocks. 59% of that performance came from just 10 of them. Now, if we take a look at the next 10 stocks, about 11% of that performance in the S&P 500 came from those next 10 stocks, which means that together, the top 20 stocks made up for 70% of this massive bull market, which means the remaining 480 stocks together eked out a paltry 30% of that bull market. Now, by the way, guys, if you've been watching my videos for a while now and you've been looking for a way to profit from the ideas that we talk about here, I want you to save this date on your calendar. January 23rd at 7 p.m. Eastern time. That's because I'm going to be hosting a free masterclass where I'll be covering one of the best kept secrets in all of finance, the asymmetric trade. These types of trades have been used for years by some of the brightest financial minds of our time. People like Big Short investor Michael Burry, Black Swan author Nassim Taleb, and billionaire hedge fund manager Bill Ackman. And I've personally used this strategy to take home some big returns in my own account over the last couple of years. And I plan on revealing everything I know at this event. We're gonna cover things like why I believe the next few months will present several massive opportunities to make asymmetric trades, and why I believe that if you wanna profit from them, you need to get into position now. Number two, I'm gonna share with you a simple and easy to to understand protocol that I follow for spotting these asymmetric trades. It's a system that has helped me take home massive gains in my personal account over the last couple of years and how you can use it in your own portfolio to shoot for massive returns. Number 3, we'll cover the exact techniques that I've used to help a small group of beta testers spot some of their own asymmetric trades over the last few months. And finally, I'll show you how you can use these trades to profit from a quickly changing political environment. Again, this event is completely free, but spots are limited. In fact, last time I hosted one of these masterclasses, we had more people register for the event than could actually fit on the Zoom call. So if you're interested in attending, it's best to sign up now to secure your spot. You can do that by clicking on the link in the description below. Now, some will say this is just the Pareto principle in action, the 80-20 rule, that most of your big extreme results are going to come from a handful of the players. This is true in markets. This is true in cities where you see a handful of cities have most of the population around the world. This is true of galaxies where a handful of galaxies have most of the matter in the universe. This is true of music where a handful of artists have most of these songs played and listened to. So this is the 80-20 or the Pareto principle at work. But as we've seen here, the level to which this is concentrated is at an abnormally extreme level, which usually precedes corrections or bear markets. So what are the stocks that are the recipients of this concentration? If you look at this chart, you can see 20 slivers or slices of this pie that make up about half of the S&P 500. The top 10 names here are going to be Apple, Microsoft, Nvidia, Amazon, Meta, Tesla, Google, Broadcom, Google, which we should really be putting those together because those are just two share classes of the exact same company, Berkshire Hathaway, and if we do combine Google into one, then we throw JP Morgan in there for the 10th. You can see here this massive other 52% of the pie is made up of the other 480 companies in the S&P 500. Now take a look at this chart here, which shows just the largest 8 stocks in the S&P 500 and what their percentage is of the market cap of the whole S&P 500. We have 4 years highlighted here. We have 1999, 2009, 2021, and 2024. Now, I purposefully cherry-picked these 4 dates on this chart because of a couple things. Number 1, as you can see, these are all highs in stock market concentration, followed by a reversion to the mean where that concentration dips back down lower afterwards. You can see 2000 it falls, 2010 it falls, 2022 it falls, and then if history is any guide, then we would also see in 2025 the concentration falls as well. But the other reason these years are important is because when the concentration falls, at least temporarily, so does the stock market. This is what the S&P 500 looked at in 1999, peaking in August of 2000 before a vicious bear market and correction collapse in the stock market. That crash took place over the course of about a year and a half. It was about a 50% drawdown from top to bottom. The next example had stocks peaking in October of 2007 and crashing 57% from its high until it bottomed in March of 2009. Now, most people don't consider this a bear market, although with commonly accepted definitions of bear markets being a 20% drawdown from top to bottom, this certainly fits, with the stock market peaking in December of 2021, seeing a 27% crash from top to bottom, which ended in October of 2022. A correction or bear market of similar magnitude from the current highs in the S&P 500 could see it drop down to the 4,400 level if we match the 2022 bear market, or even down to the 2,600 level if we match the 2009 Great Financial Crisis bear market. Now, to be clear, a bear market of that magnitude, a crash of 30, 40, 50, 60%, in my opinion, extremely unlikely. But a 10% correction or even a 20% bear market similar to what we saw in 2022, that would not be unreasonable at all to at least be prepared for. Preparation for extreme volatility like this in the market can come in a number of shapes and sizes. Number 1, something as easy as having dry powder, just some cash on the sidelines ready to deploy if assets go on sale. Number 2, having some aggressive stop losses in place on your simple stock or ETF positions. Or if you want to get a little crazy, maybe even a trailing stop. Or number 3, some well-timed puts when the VIX is very low and the S&P has just had a few good solid green candles in a row. None of these things are very difficult, and I highly recommend taking a more active role in your financial education and in your own portfolio management. If you're ready to take that next step, I invite you to join my asymmetric trading masterclass that I'm hosting live next Thursday, January 25th 23rd at 7 p.m. Eastern time. Over the past few years, I've been using asymmetric trades to take home some massive returns for myself, and I've been helping a small group of members do this as well. Next Thursday during the masterclass, I'm going to teach you how to do it. And with this next year looking like there's going to be a lot more volatility than we've seen recently, it just means more opportunities to make money, and I'd like to teach you how to do it. If that sounds interesting to you, the link is in the description below. Go ahead and click on the link and make sure you save it on your calendar. As always, thanks so much for watching. Have a great day.